$9.40. That's the straddle on IonQ right now, and it's pricing a 24% move over the next month. Not up, not down, just how big. What's up, guys? Coach B here. This is the breakdown. Today we're using one reel, live setup, IonQ to teach something that works on any stock with options, how to read the implied move off and at the money straddle. IonQ is the example here. The skill is the actual point. Quick context on why this chain is even worth looking at, because it's a wild one. A month ago, IonQ closed at $48.87. By July 29th, it had fallen all the way to just under 32, a sell-off of about 34.5% in 3 weeks. Since that low, the stock has turned around hard, closing Monday at $38.85, up more than 21% in just a few sessions. This is a stock that's been moving fast in both directions, and now it's running straight into earnings. Quick reminder up front, this is education, not financial advice. I'm not telling you to buy or sell IonQ or anything else. Do your own research. Here's the calendar that matters. IonQ reports earnings tomorrow, August 5th, after the closing bell. The chain I'm using for this breakdown expires September 4th, 31 days out from today. That expiration sits 30 days past earnings. So the 24% move I opened with isn't a pure earnings day number. It's the market pricing the whole month, earnings included, plus whatever happens after. Let's pull up the actual chain. Spot is right around 38.85. The at the money strike is 39. The 39 call is bid 420, ask 545, pricing around $4.83 with implied volatility around 105%. The 39 put is bid $4, ask $5.15, pricing around $4.58 with implied volatility just under 100%. Both numbers are elevated, roughly triple what you'd see on a calm large cap stock. Call and put, same strike, same expiration. That's what builds the straddle. Put those two legs together. The call's pricing around $4.83. The put's pricing around $4.58, and together they price out to a straddle of about $9.40. Divide that by the stock price, $9.40 over $38.85, and you get about 24.2%. That's the math behind the number I opened with. It's not a chart pattern and it's not a guess. It's literally what the call and the put sitting right at the money cost to buy right now. Here's the part people get wrong. That straddle tells you the size of the expected move. It tells you nothing about direction. A 24% move up and a 24% move down both satisfy that price. And whether 24% is rich or cheap depends on what the stock's actually been doing. We just showed you IonQ ripped about 21% higher in less than a week on top of a much bigger swing the month before that. So is a 24% priced move for the next month expensive, or is it modest next to what this stock has already shown it can do in a matter of days? That's the real question, and the straddle price is just your starting point for asking it. Let's make this concrete. If you bought that straddle outright, one call and one put, it costs about $9.40 a share, $940 for one contract of each. For that trade to actually profit, IonQ has to move outside of roughly $29.60 on the downside to about $48.40 on the upside by September 4th, and it has to move enough to cover what you paid. Here's the risk. Combined, those two legs are bleeding close to $15 a day in time decay, and a lot of that decay is scheduled to speed up right after earnings. The company reports tomorrow, the uncertainty resolves, and implied volatility can collapse overnight even if the stock moved a decent amount. That's the classic IV crush. You can be right that the stock moved and still lose money if it didn't move enough, fast enough to outrun what you paid for it. So how would I actually think about a chain like this? If you're trading earnings specifically, you're paying for a number that already assumes a big move. So the bar to profit from a straddle is higher than it feels. If you're just trying to read the tape, that 24% figure is your best single estimate of what the market expects, full stop. And you can build a swing plan or a hedge around it without ever touching a straddle yourself. Either way, the number is information. It is not a signal to buy anything. So let's recap the actual skill, because this works on any ticker. 1, find the at the money strike and add the call mid and the put mid together. That's your straddle. 2, divide the straddle by the stock price. That's your implied move, a magnitude, not a direction. 3, check what's actually inside that expiration window, because a number that spans an earnings date is pricing more than just the earnings reaction. Same reminder as always, this is education, not financial advice. I'm not telling you to buy or sell IonQ or anything else. Do your own research. Subscribe, and I'll break down the next name's chain the same way. Good luck in the markets, no matter what stock you're into.